Good afternoon, everyone, and good morning for those of you joining in from the West Coast. In commemoration to Black Heritage Month, we thank you. So today, our colleagues from research will present on the intersection of climate risk and inequality. Our presenters today include Raji Chakrabarty, who is a senior economist within the microeconomic studies, and as well as Don Morgan, who is an associate vice president and financial economist within financial intermediation. These presentations will be followed by a panel discussion and audience Q&A featuring our presenters and Danielle Baird, who is the founder of Black Power and who is a 2nd District Advisory Council member to the New York Fed. To kick off today's discussion, the Executive Vice President and Head of Supervision Group, Kevin Styrel, will be delivering today's opening remarks. So Kevin, you have the floor.
So good afternoon, everyone. It's really a pleasure to be here today and participate in today's discussion. As you know, this event is part of the bank's work around Black Heritage Month, and I'd like to thank the organizers, Sonia Khan, Sergio Olivas, Javier Silva, Philip Stone, and Alyssa Trinidad for putting this together and for giving me the opportunity to make a few introductory remarks. The increasing global attention on the economic and financial impact of climate change serves as the background for today's discussion. In particular, we're going to hear more about an important aspect of climate change, the fact that climate change is having a disproportionate impact on underserved communities and communities of color. In some ways, this is a long-run development, but it is especially pertinent today as we confront a global health crisis that is also having disproportionate harm on low-income communities and communities of color. And while the most severe impacts of climate change are likely to be in the future, the effects are already here. As Governor Brainerd discussed in a speech last week, there is growing evidence that the extreme weather events related to climate change are on the rise. Droughts, wildfires, hurricanes, and heat waves. These impact all of us. And within the Fed, we are increasing our understanding of the risks and the opportunities as the economy and the financial sector respond and adapt to meet these challenges. The Fed, for example, has made a public commitment to these efforts by joining the Network for Greening the Financial System and by co-chairing a Basel Committee task force on climate-related financial risks. Here at the New York Fed, we are thinking about this from a range of perspectives across the bank: supervision, legal, markets, research, and community development. Today's event will focus on an important fact, that climate change is having a disproportionate impact on underserved communities and communities. In a different speech last December, Governor Brainerd highlighted this fact and discussed the potential role, for example, of the Community Reinvestment Act. And today we'll see evidence that climate change is having a disproportionate effect on mortality, access to credit, bankruptcies, and migration for certain communities. I think the New York Fed's community development team is also exploring efforts to lift up comprehensive climate adaptation practices and investment opportunities. Taken together, these initiatives will help us to better understand and address the emerging risks in our communities in the 2nd District. So again, many thanks to the planning team for around Black Heritage Month and to the resource networks for organizing this important and timely event. And I'm very much looking forward to the interesting discussion to follow. Thank you.
Thank you, Kevin, for those kind words. So without further ado, I'll present our first panelist, Raji. I won't steal much of her thunder, so I'll let her introduce herself and her work. So Raji, you have the floor.
Thanks, Sergio. I'm Raji Chakrabarty. I'm an economist in the research group of the New York Fed. And today I'm going to talk about climate risk and inequality. This work that I'm presenting today is part of a considerably bigger body of ongoing work on climate and inequality that's ongoing with Christian Blakely and Maxim Pinkowski. This work is spearheaded by Joao Santos, and it is hopefully will be completed by the end of this quarter. And it has tremendously benefited from feedback from many of our supervision and markets colleagues. So the climate risk has impacts on economic output, but it also has important implications for economic inequality. It's a second aspect, climate and inequality, that I will focus on today. So let's see. You can still hear me, right? Okay, I'll take that as an yes. So climate change is associated with two kinds of risks that is very well known: physical risks and transition risks. Physical risks relate to interruptions in economic activity and losses for businesses and consumers due to climate changes and disasters. Transition risks come from changes in policy, or let's say technology, or consumer behavior or sentiments in the path to a lower carbon economy. As this presentation will hopefully convince you that neither physical risks nor transition risks are distributed equally across income, race, and geography. In fact, these risks affect populations quite unevenly and lead to very different effects across them, as hopefully you will see throughout this presentation. So first, what are the mechanisms through which climate change can affect inequality? Broadly, this can be threefold, which I'll discuss separately in three different parts in this presentation. First is the direct channel. Damages from climate change are not equally distributed. In fact, they're distributed quite differently across income, across race, and across geography, and you will see some evidence to that effect later in the presentation. Also, adaptations are really key to adapt to climate change or climate risk, to protect yourself from climate risk. These climate change lead to adaptations to counter losses from climate change, but these adaptations are not equal across demographics and across geographies, as you will see, hopefully. Finally, institutions and policies that aim to combat climate change can have very different impacts across demographics and across areas. And I'll talk about that as well. The first point here falls under physical risk. The second and the third, adaptations, as well as institutions and policies aiming to combat climate change, falls in the second and the transition risk. And you'll see there are differences in distribution in each of these. So moving on, let's first look at the effects, the direct effects of climate change, and whether or not these are different across demographics and across regions. So this chart is taken from a paper by Carlton and Greenstone and others. And this is really looking at effects on mortality risk of climate change. This paper looks at cross-country data, and they actually look at about 40 countries and find a U-shaped relationship where extreme cold and extreme hot temperatures can actually increase mortality rates, especially for the elderly. But they find that it is flattened considerably by higher income and adequate adaptation to climate change. For example, let's say robust heating systems in cold climates or cooling systems in hot climates. Here, I'm taking one chart from their paper that looks at full mortality risk that includes both the direct mortality risk as well as costs and benefits from adaptations to climate change, which in turn varies across climates, across the income distribution or the income of different countries. And as this chart shows you, mortality risk actually varies markedly across income. And you can see here that the mortality risk is considerably higher. If you focus on the white circles, which actually captured the means, without looking at the distributions that are captured in the rectangle, the blue rectangles that you see there. But if you only look at the white circles, you can see that mortality risk is actually considerably higher in lower income deciles and in lower income countries. So that is, and this is actually seen in all the different components that they look at. Say in addition to looking at mortality, They also look at other costs like cost to agriculture, energy, such as electricity costs, cost from increases in crime, coastal damage. In each of these categories, they find the very same effect, which is that income really matters. Now, moving on to this next slide, here we are looking at maps that are taken from a paper by Siang, Kopp, and their co-authors. And they're looking at expected climate change damages by late 21st century. And the left chart looks at climate change damages, effects of climate change actually on mortality. And as you can see that the distribution is far from uniform, and the South is going to be considerably worse affected by the end of this century. And that's kind of seen again in various different metrics that they look at. I'm just presenting two charts here. The left one is on mortality. The right one, they actually call it total damage, and this total damage includes all these different costs that I talked about before. So it does include mortality, but it also includes costs to agriculture, energy costs, which is mostly electricity costs, costs to labor, costs of crime, coastal damage, etc. But the picture comes out to be quite similar. And it is the case that the South is going to be considerably more affected. It is also the case that we know that the South also has typically concentration of lower income populations, and that might have implications on inequality as well, just because of that. So not only is geographic inequality is what you can see that can result from climate change damages, but also inequalities by income. Now, moving further on, climate change damages on household finances are not uniform either. So here I'm drawing from two papers. One paper is by Bridget Rothfriend and her co-author, and the other paper is by Zach Bleemer and Wilbert Vanderklau. The first paper looks at a variety of disasters and looking at cross-country data. The later paper looks at the effect of Hurricane Katrina. Both of them are actually using data from the New York Fed Consumer Credit Panel. So some findings as listed here from these papers. The first paper finds that likelihood of bankruptcy is considerably higher for individuals in lower income neighborhoods. And they also find that likelihood of bankruptcy is also considerably higher for individuals with lower credit score. The second paper looks at home ownership, and it finds that declines in home ownership is markedly less for individuals from predominantly white neighborhoods compared to individuals from predominantly African American neighborhoods. This paper, this is another paper I'm drawing from by Ratcliffe and co-authors who look at the effects of disasters and they differentiate between the type of disasters, and they look at effects on credit scores. This paper differentiates between disasters that are called medium-sized or larger disasters, for example, Hurricane Sandy. So as we can see that the effects are greater for medium-sized disasters in areas where majority population is people of color than for larger disasters. Residents hit by medium-sized disasters can actually experience greater financial struggles because these disasters do not receive as much federal support that larger disasters receive. So if you look at these two charts, there are basically two charts here. The right-hand side is looking at medium-sized disasters, and they're looking at effects of these medium-sized disasters 1, 2, 3, and 4 years after. And then the blue line is looking at effects in areas where the majority of the people are people of color, whereas the gray is looking at effects on areas that have majority white population. In the right chart, what you see is that there is a divergence between these two lines, which actually shows that there is a divergence in the adverse effects from credit scores as time passes by. And it is quite large at the end of the fourth period of the fourth year. On the left-hand side, when there is a big disaster, there is also federal help that comes in, and to some extent that is seen here to reduce the gap, in the sense that at the fourth period after, you see that these two lines are very close to each other. So type of disaster matters, and as well as outside help, like federal help, does matter as well. So climate change can also affect inequality through social and labor market linkages. So, for example, extreme temperatures disproportionately lowers productivity in certain industries, for example, in agriculture. And there is a recent paper by Ishan Nath that actually shows that the productivity effects of climate change reduce welfare by around 2% overall, but between 6 and 10% in the poor. So again, there are differences by income, as you can see. And oftentimes, agriculture is considerably higher because of higher temperatures that affect agriculture adversely, or lack of precipitation, for example. And because agriculture is oftentimes more concentrated in relatively low-income countries, that also has adverse consequences. There's this other paper that I'm drawing from here, Bark and co-authors, that review literature on climate and conflict. They actually find deviations from moderate temperatures and precipitation increases conflict, including both interpersonal conflicts, such as assault and murder, and intergroup conflicts, such as riots and civil war. And then let's look at adaptations to climate change and whether or not adaptations are actually different across areas and populations. So here, what we are looking at, so first of all, adaptations, the literature has found that is actually markedly different across incomes, access to residential electricity, residential air conditioning, access to healthcare is different. Ability to elevate homes in flood-prone areas is also different. And another paper by Dell, Jones, and Olkan, they actually show that high temperature adversely affects growth considerably more in poor countries. And differences in adaptation can actually make a difference, and they find the differences in adaptation can actually explain about half of the negative effects of temperature. So higher adaptation can actually reduce the negative effects, and that is also another way that inequality creeps in here. Another way to adapt to climate change is migrate away from disaster areas. And it has also been found, and it's the same two papers that I cited before, the Rothstrand and co-author and Vanderklau and co-author, they actually show that individuals from higher income areas and from predominantly white neighborhoods are actually more likely to migrate away from after a disaster. And then the final part is looking at institutions and policies combating climate change and whether or not there can be inequalities in that dimension. So first of all, looking at disaster insurance. Access to disaster insurance is not equal, and it is really key to protect oneself from climate change. And it's important for post-disaster recovery. However, access to insurance and insurance take-up is quite different. This paper that I'm citing here, Atreya and co-authors, they find that higher educated individuals over 45 and African Americans are more likely to buy flood insurance policies. And it is also the case that this disaster insurance is often priced to reflect climate risk. They are often less affordable in low-income communities. Disaster risk and lending is also another way in which people do combat after a disaster risk. After disasters, there is a heightened demand for credit, but access to credit is really not equal across income and across race. There is this paper by John Mays and others, that paper shows that insurance market imperfections can actually restrict supply of credit after a disaster. And this is actually more severe. The access to credit difficulties are considerably more severe in Black, lower income, subprime, that is lower credit score, and underbanked communities. And Don Morgan, presenting in a minute or two, will actually talk about this in considerably more depth. And this is also the case in muni markets, municipal bond markets. So disasters lead to an increase in credit there as well, but because of increased susceptibility to disaster risk, oftentimes the low-income communities get lower credit ratings. As a result of that, it is often difficult to issue long-term municipal bonds, and that in turn actually affects the ability of such communities to build up to finance long-term projects that might actually guard against climate risk. And then there is oftentimes unequal distribution of FEMA relief. There are papers, as I'm citing here, you can see that FEMA relief has been shown to have been different across communities by income. Low-income neighborhoods receive less in FEMA assistance oftentimes. Neighborhoods with higher share of minority homeowners received actually a lower FEMA or were less likely to receive FEMA assistance. And climate change and FEMA aid can actually exacerbate wealth inequality as well in this way, and can actually expand gaps by race, education, and home ownership. And there can be regional variations in federal disaster insurance as well. So there is this paper by Willis and co-authors that shows that federal response to hurricanes in Florida and Texas have been quite different than, for example, response in Puerto Rico. It was considerably larger as well as much faster in Florida and Texas, and that can actually itself exacerbate health inequalities and income inequalities within Puerto Rico, for example, as well as between regions. So what are the main takeaways? So climate risk can have, as we can see, as we have seen, very uneven effects by income, race, geography, and education. And these include from direct effects of climate changes and disasters. This also include differences in adaptations to climate risk, also differences in access to insurance and bank loans, and as well as differences in effects from policy. Looking forward, times are actually quite different. We have exciting changes happening in the climate risk arena. The Fed is actually has joined NGFS, as Kevin referred to in his initial intro. Fed is also moving to incorporate climate risk in both its microprudential, macroprudential oversight of banks, using tools that could include climate scenario analysis, climate stress tests, to measure banking systems' vulnerability to climate-related losses. There are also efforts to include climate risk in CRA, so to support climate resiliency in low and moderate income and underserved communities. And this can definitely have implications on inequality and potentially reduce inequalities and bridge gaps. And we definitely need more research and more comprehensive data to understand these implications. And I'll stop here and pass on to John.
Thanks, Raji. It's a real pleasure to be here. I want to thank the organizers for including me. I'll wait till my deck comes up. But I'm going to talk about some research that I have underway with various co-authors I'll name later. One strand is on climate risk for banks. The other strand is on financial inclusion and unbanked households. In my mind, and really on paper, those were separate strands, but I really credit the organizers for challenging me to think about the intersection between those. So I have three takeaways, which I think rank sort of in decreasing order of obviousness. The first and most obvious takeaway is that credit is handy to have in a disaster, really any disaster, but in particular weather disasters, which tend to be temporary. Even expensive credit, like overdraft credit, where the bank covers your check that might have otherwise bounced, or small dollar loans, like payday loans. The second, slightly less obvious point is that households with a bank account also have better credit access. It's not entirely obvious, it's a deposit's an asset and a credit's a liability, but there's synergy between those that can increase credit access for banked households. It follows almost logically that if we can draw financially excluded households into the banking system, of which there are more African Americans and Hispanic households, if we can make those households banked, if nothing else, we can promote climate readiness along that dimension, or climate resilience. The third point I'm going to make, which is definitely the least obvious and possibly arguable, is that overdraft fee caps as a way to try to increase the availability of overdraft credit and increase financial inclusion may backfire. That's the work in progress with Jen Douglas at the board and Ryan Melzer at Dartmouth. And I'll elaborate that later. And we propose at the end in our paper, we recommend increasing competition in overdraft as a better way to promote financial inclusion and thus financial resilience. Wrong. So first and most obvious point, which I'll breeze through, disasters, weather disasters specifically, increase the demand for credit. The Bank of America actually, back when it was known as the Bank of Italy, made its reputation, its name really, by lending generously after the 1906 San Francisco earthquake. There's a very well-known paper by Adair Morse, a Berkeley economist, who shows that households in California located in zip codes where payday lenders tend to congregate. Weather California disasters, of which there are of course many, with less hardship than households with the same income where there's less payday credit. It's an interesting result. It's the paper's provocatively called payday lenders, heroes or villains. The third bullet there is from work in progress with Christian Blickel here and Sarah Hammerling. We're looking at how weather disasters in a given county affect banks operating in that county. And among other things, we find that bank lending generally by those banks increases significantly, 1 to 3% over the horizon we've shown. That's not a new result. There's many papers out there who show that demand for bank credit of various types, mortgages, consumer, increase after disasters. It's not really a surprise. Income can be disrupted. Households don't want to cut their spending or standard of living because of a storm if they know they'll be back to normal in a week or a month or two. Going to the end. Slightly less obvious, second point. Households with a bank account also have better credit access. That's literally true for small dollar loans like overdraft credit and payday loans. A payday lender, even as risk-seeking as they are, won't lend to someone without a checking account. It's part of their lending mechanism. More generally, there's a long notion in banking of synergies between deposit taking on the one hand and lending on the other. The depositor's account balance and the variability, its fluctuation, can inform a banker's lending decisions about who to lend to and how much to lend. The FDIC, which really tracks the unbanked issue very closely, they have a semi-annual survey and report. They say it quite bluntly that having a bank account can facilitate household access to responsible, affordable credit. This slide from the Federal Reserve's in 2019 shows that African American households and Hispanic households are considerably less likely to have a bank account, or more likely to be unbanked, said other words, than white households. Roughly 1 in 7 African American households are unbanked, and 1 in 9 Hispanic households versus 1 in 25 white households. So there's a big difference there. The question then, and it, oh, by the way, keeping on theme, sorry about that. Keeping on theme, it follows, the premise here is by being unbanked, just for that reason alone, these communities of color or households of color are more exposed to ill effects from the weather disasters that climate change is expected to bring. Well, if we want to try to increase inclusion, we have to know why households are unbanked. Here's from the FDIC's survey of unbanked households in general, not specifically minority households. There's a long list of reasons that households who are unbanked cite, but some reasons clearly matter more than others. In particular, fees, which I've highlighted or circled there, those are far more important in the unbanked depositors' minds than location. And I developed this point with Maxim Kinkowski, who I think is on the call or in the meeting, in a Liberty Street blog post. But what we actually map banking deserts, where we define as a census tract with no bank within a certain distance. And we map it, and it turns out that virtually almost all these banking deserts are literally in the desert. There's really almost none in urban areas. There's a lot of banks. There's branches everywhere, and in the city. So we don't think that's a first order problem. And in fact, we show that the correlation between the share of households that are unbanked in a state and the share of households that live in a banking desert, as we define it, is essentially zero. Far more important in explaining unbanked households is account fees. This last bullet is particularly important. If you look at depositors who report they've had their account closed because involuntarily, because of excessive or unpaid overdrafts, they're said to have bounced out of the banking system. Half of those depositors cite costly overdrafts as the main reason. So if we want to have policies that promote inclusion and thus resilience, we need to think about, well, how can we increase inclusion? Obviously, that's an old question. Policymakers have been talking about the unbanked for years now, even decades. But one policy that's been considered is fee caps. Now, the idea is if overdraft fees are part of the problem, then perhaps fee caps or limits or ceilings is part of the solution. So there was a federal cap proposed in 2019. It entered both the Senate and the House. It did not advance. Senator Booker, who sponsored the bill in the Senate, noted that overdraft fees are pushing low-income households away from banks altogether. He's correct. The last slide just showed that fees are a major issue for the unbanked. The next step is trickier though. Fee caps, which is what this bill would have done, can have an unintended effect of limiting access to overdraft credit for riskier households. And to be clear, what I mean by overdraft credit is the bank covers a check that would have bounced, or they grant you access to funds at an ATM or a point of sale. I've got a trigger warning here because this is going to be maybe a flashback to EC 101, and I even have the supply and demand model to illustrate this. So let me develop this for 1 minute. Overdraft credit is just credit for a fee instead of for interest, but it's credit. It's well known that interest ceilings or usury limits restrict access to riskier borrowers because banks or lenders may not be able to cover the risks at that ceiling price. So it follows that a fee cap, which is essentially a usury limit for overdraft credit, could limit access to credit to riskier depositors who might overdraft and then perhaps not be able or willing to repay. The chart there on the right just illustrates that. If you have an interest rate or a fee cap below sort of the market clearing price, which reflects banks' costs of funds and risk, if you're below that equilibrium or clearing price, you're going to have less supply, and you're going to have this set of riskier borrowers who get rationed. And in less textbook terms, in this context, what that means is a household that might have had a check covered by the bank at the higher price might instead have it bounced by the bank at the lower price. And that's costly. When you bounce, as some may know, I've had the experience, I said, when you bounce a check, you owe the bank a fee for insufficient funds of around $30, and you may owe the merchant a fee for the same amount. That's potentially $60, and not to mention the sort of acute embarrassment when you have to go into the merchant and shamefaced write a better check or pay them cash. So that's the theory. That's a textbook prediction, really, of how a fee cap and overdraft might have ill effects. In research that I have ongoing now with Jen Douglas at the board and Brian Meltzer at Dartmouth, Jen actually noticed that there were a few states circa 2000 that had overdraft fee caps, but national banks that were nationally chartered banks that are regulated by the OCC, those national banks were exempted from that fee cap. That's what we call in this business a natural experiment, where we can identify the effects of the fee cap by comparing states with or without and national banks versus other banks. What we found with that analysis is that after the exemption in 2001, national banks did raise their overdraft fees, but they also covered more overdrafts at that higher price. We found, secondly, that return check rates at Fed check processing centers in those states, with limits, that is, declined substantially relative to other groups by 15%. That's a notable result by itself because it implies a substantial savings to a check writer that might have had a check to bounce at a cost of, say, 60 if you have to pay 2 fees, to just the cost of paying the bank for the coverage, which might be 30. Plus, they're spared the embarrassment. Third, and more to the point here, is that we found that low-income households that were in those states were more likely to have a bank account, a checking account, and less apt to bounce out. So, in other words, the question of whether they backfired, it seems that they did. We found under the cap, before the exemption, less banked households, more bounce checks. This just illustrates the last result.
Apologies,
sorry?
We're slightly pressed for time. Hopefully we
I got 1 minute. This just, I'm on my lap. This illustrates the result. The vertical axis is just the share of low-income households that are banked. It's a little blurry, sorry, but that's what's shown. And time on the horizontal axis, dashed vertical line, is when that exemption happened. And the share banked rose significantly, around 5%, and stayed high for several years, as long as we looked, actually, after that. So the fee cap actually had a perverse result. If the goal was to increase inclusion, it appeared to reduce it. So we recommend, in the end, competition instead of caps. This is another Econ 101 point, but competition is essentially the market or nature's way of curbing prices, right? With vigorous competition, prices of services should be driven down to roughly the cost or risk involved in providing them. Overdraft, there's no question, is very profitable to banks and credit unions to the tune of $35 billion a year. There's virtually a fleet of boats out on the internet named overdraft, reflecting, I think, the revenues from that. We don't investigate competition in that space directly in our paper, but from afar, it seems quite weak. There's no competition for overdraft. I've never seen a bank saying, we have the lowest overdraft or NSF fees in town. There may be a policy reason for that. Regulators may discourage it. It seems worth investigating. But competition does work in this space. Another paper with Brian Meltzer, and we found that when banks cover more checks, provide more overdraft credit, when they're forced to compete against payday lenders, because the state allows payday lenders. So just to recap, no pun intended, communities of households of color are more likely to be unbanked and so less ready for the weather disasters that climate change is expected to bring. Capping overdraft fees, though it's an understandable policy urge, given how high they are and the complaints about them, may have actually unintended or even perverse effects of reducing inclusion and increasing the cost of an account through bounce check fees. And lastly, just promoting competition, Econ 101 might be a better path to inclusion and financial readiness. Thank you.
Thank you for that presentation, Don. Now we'll kind of transition into the panel, but before asking our very first question, I wanted to give our third panelist, Danielle Baird, an opportunity to talk about himself and the work he kind of does with Block Power.
Great. Can you all hear me?
We can hear you, but just not see you, if that's okay.
Uh-oh. What about now? Great.
Yes.
Perfect. So, hi, everybody. I'm Danielle Baird. I am a climate tech startup CEO. I run a tech company that focuses on greening buildings in low-income communities. And what are we trying to do? We're trying to turn buildings into Teslas in the same way that Tesla is ripping out the fossil fuel equipment and infrastructure of vehicles and converting them to 100% electricity. We want to be able to do the same thing to buildings in low-income communities. We have the hardware and the software and the financing to do that. We couldn't do it 10 years ago, but we can do it now. And it's important that we focus on this for several reasons. One, 67% of all the greenhouse gas emissions in New York City, where the New York Fed community is located, 67% of the greenhouse gas emissions in New York City come from the buildings. And so those buildings are burning oil, they're burning gas for heating, for cooling, for air conditioning, for hot water. We need to move those buildings off of fossil fuels and move them onto 100% electricity and dramatically reduce the amount of greenhouse gas emissions that are coming from buildings. Nationally, we know that buildings produce 30% of US greenhouse gas emissions overall. Worse than that, building owners in low and moderate income communities are wasting hundreds of billions of dollars to pay for fossil fuel energy. They're paying the utility companies for the energy, for the electricity. They may not even use it, and it may be just wasted. So there's hundreds of billions of dollars of waste. And even worse than that, the buildings are making folks sick. The buildings have lead, they have asbestos, they trap indoor air pollution and recirculate it around schools, around apartment buildings, because the equipment is old and antiquated and it's based on unhealthy fossil fuel systems. And so as we start to electrify buildings, we expect to see energy saving, air quality and public health benefits. We expect green infrastructure investors to make a financial return. And we expect to see local jobs that are created in low-income communities as we train people to go building to building and convert them from fossil fuels to all electric buildings. I think the last point I'll make, to take 30 seconds, is we've recently announced a $50 million facility with Goldman Sachs. And what we're doing is we're incorporating the projected energy savings and fossil fuel cost reduction from greening an apartment building and shifting it to 100% electric energy. That is going to generate so much energy savings, greenhouse gas emissions reductions, and utility bill savings that Goldman's and their investment committee has allowed us to incorporate those potential future electricity bill savings into the current underwriting criteria. So as we do analysis of whether or not it makes sense to invest or lend capital to a building in a low-income community, we're not only able to look at their financial pro forma, but also able to incorporate the future potential utility bill reductions and incorporate that into the cash flow analysis as we determine whether or not a building can make its debt service coverage requirements. So we're super excited to be here today and really enjoyed the presentation so far. Thank you.
Thank you for that, Danielle. So, with the remaining time that we'll have left, we'll see through how many questions that we can get through. So this one's kind of as a general question. As this generation shifts into greener environments, policymakers will look to ways to minimize climate risk in various communities. How would you define or identify components of a climate resilient community? And I'll hand this over to Raji to take the lead.
Thanks, Sergio. So, well, there are different ways. So, one comes to mind is types of infrastructure. Changes of infrastructure could actually help. I think policies can also play a pretty big effect. So, as you know, recently there was this presentation by Richard Rothstein. He has a book that actually looks at public policy and how, especially in the South, but also in the North, there has been, public policy has systematically excluded minorities, most particularly Black Americans, and caused them to live in maybe undesirable areas like environmentally hazardous areas, or there are lots of deposits of hazardous materials or polluted areas. There was also this one New York Times recent article that shows that, low-income and minority areas have often live in areas or cities that have considerably fewer green spaces and considerably more concrete paving than do more affluent and non-minority areas. So public policy can have a role to play here, as well as from individuals' perspective. I think thinking of elevating houses in floodplain areas, trying to get ACs, etc., set up, which of course differs. Again, it does differ by income and race, the probability of doing this or the access to this, but these do matter. But in generally, having more green spaces and less concrete can definitely make a difference and make communities more climate resilient.
Yeah, I agree with all that. I would add that low-income communities need to own the distributed, decentralized, green, and renewable energy infrastructure that's going to be installed in low-income communities as a part of smart grid or smart green buildings policy. Not only do we want to have access to the jobs on construction and installation that are created by these green infrastructure projects, but as energy starts to distribute itself and become smaller, modular, more consumer focused, where we start to produce and consume our own energy closer to our own homes and buildings, we want low-income communities to literally own equity stakes in those green infrastructure assets as they're rolled out, in the same way that rural electric co-ops, cooperative utility companies in rural parts of America, all of the farmers own shares in a local nonprofit co-op that kind of owns and controls the local electric utility, which was part of Franklin Delano Roosevelt's policy. We want to bring that policy back, and so that as we roll out renewables across the country, particularly in low-income communities, we have access to the jobs, we have access to all the health benefits and financial returns, but we also are owners of that infrastructure so that we can enjoy the upside of those assets.
Okay. On to the next question. So Raji touched on mobility as a part of the climate risk adaptation. Similarly, we kind of saw in the early stages of the pandemic that higher income households who could work from home, they left denser cities to the suburbs, while essential workers who disproportionately compose of lower income and minority individuals kind of stay put. What's the reason behind these differences in mobility behaviors, and are there any potential factors to mitigate the inequality? So, Raji?
Thanks again, Sergio. Yeah, can you hear me, right? Okay, great. Yeah, exactly. As you pointed out, there definitely are racial and income gaps in work from home patterns. And in fact, Maxim Pinkovsky, also a colleague of mine in the research function, and the economists, both of us together, we have a recent blog post that actually looks at that and shows these differences. across race and income, the work from home and the commuting to work pattern. A lot to do the type of education, the differences in type of education, the type of job. So for example, managers or workers in finance and law, they can work from home, whereas cashiers and delivery workers and let's say postal workers have to commute to work. And related, as you point out again, in after disasters, migration is very differential across income and wealth, etc. So it is true that when we see migrations, that's and in terms of what may be the potential factors, so in terms of the potential factors, as I pointed out, public policy can more equality can also be a factor. You stop there.
Okay. Then I wanted to direct one more question that Don could talked about, particularly since he had talked about preparing for climate disaster in terms of being banked. So more generally, the board publishes an annual report on economic well-being that includes a pretty well-known question. Could you cover a $400 emergency expense out of pocket? For last year, 48% of Black respondents said yes, compared to 55% of Hispanics, and 77% of white respondents said yes. So how does being financially prepared for climate risk different from being prepared for any sort of emergency expense? Don, you're muted.
Yeah, sorry. Yeah, interesting question. I think to a first approximation, financial readiness for a weather disaster is not fundamentally different from financial readiness for other types of disasters, health emergencies, personal disasters. I mean, there is this, there's the expression, a rainy day fund. It's not really literally just for rain, it's just for disasters. The one possible difference between a weather disaster and others is that weather disasters of the type that I've been studying, hurricanes and so forth, tend to be temporary. And so credit is a natural, if you need credit, it's a natural response to borrow your way through it. Other disasters can be more long-term. So borrowing is not necessarily going to be the right response. One might have to lower their standard of living or some other adjustment. So my point there is just that for weather disasters that are temporary, financial readiness, credit is a more important part of financial readiness than for, say, other types of disasters.
Okay. And so we do have a couple questions through the Q&A, but here is one that's kind of open to all panelists. So what are your thoughts on President Biden's administration executive order on tackling the climate crisis at home and abroad? In this, I will hand over to Danielle.
Yeah, and we're really excited to see the speed and aggression and prioritization that the Biden-Harris team has provided to climate. I agree that it's among the most pressing issues that our country faces. And even as we're working our way out of the pandemic, we need to make sure that the way that we do that is through investments in smart, healthy, green infrastructure across the country that's going to protect us from pandemics and protect us from climate while creating good paying jobs that are the foundation for a middle-class lifestyle. So the Biden-Harris team seems really committed to doing that. They've made really smart hires. They've made really great executive orders. I think of particular interest is the commitment that they've made to ensure that 40% of the benefits of all of the capital that they invest in climate and mitigating climate and in resiliency across the country and in green infrastructure, 40% of those benefits are mandated to benefit low-income communities across the country. Now, that's a significant commitment on their part. It's a really significant policy that could be really transformative for the way we think about climate resiliency in this country. And so the devil's always in the details, but personnel is policy. And the team that the Biden-Harris folks have assembled, I was just on a call with Shalonda Baker, who's the deputy director in charge of environmental justice, and some of the folks they're bringing into the White House to work on this under Gina McCarthy on the domestic climate side. It's just a truly impressive team whose heart is in the right place and have the technical savvy to understand and implement a set of solutions that give us an outside shot at starting to mitigate some of the worst impacts of climate change. So I'm impressed with the team. I'm impressed with the policy direction. The devil's in the details of implementation and in figuring out how we work with Americans of all stripes to really get into a national mission of working our way out of the pandemic and doing so in a way that reduces greenhouse gas emissions across the country and across our economy.
Thank you, Danielle. Unfortunately, we've run out of time, but I'd like to thank our panelists' presentations and their participation in today's session. I'd also just want to give a direct shout out to Javier, Alyssa, Sanya, and Phil, as well as the rest of the planning committee for helping to put this together. And as always, stay safe and be well.
Hear, hear. Thank you.
Thank you.
Happy Black History Month.